Hi, it's Michael Douville from Scottsdale, Arizona. As usual, it's beautiful. The weather's cooling down. It's in the mid 80s. It's sunny and blue skies, so it's a pretty doggone nice place to live. And it's part of Maricopa County. You know, in Maricopa County, we're getting 222 people a day that's coming here. Weather is part of that deal. And retirees are coming here left and right. So the growth factor for Maricopa County is pretty phenomenal. But hey, that's not what I wanted to talk to you about today. You know, I've been pounding the table thinking that the stock market is at risk. I think it is enormously at risk. It just keeps going up. We talked about, I wrote an article about the correlation between the stock market and the U.S. dollar. And of course, the U.S. dollar has been dropping ever since Donald Trump was elected. It's dropped about 12.5%. So we have a stock market that's up about 14 or 15%, and the U.S. dollar that's down about 12.5%. So pretty strong correlation there. So the U.S. dollar keeps going down, and I think it's helping to drive the stock market up. But that's really not what I'm calling about. I think so I've been saying that I think if the dollar starts strengthening, so that might be a trigger point for everyone. So we need to take a look at that and make sure that once the dollar stops. Because it'll get to a point where it stops declining and it's going to turn around and start hitting back. I have data that suggests that we're looking at we've dropped from 103 down to 92, and looks like we could go back to 103. But I have someone else saying we think we could get back up to 120, which would be a double or triple top, which technically would just be would be perfect. Everybody would think, gosh, that's technically exactly what should happen. Let me tell you, a dollar that goes from 92 to 120 would devastate the stock market. It would devastate the markets around the world and just cause enormous problems. So if that's happening, wow, that'd be a heck of a trigger. So that's really not what I want to talk about. But let's just go down that a little bit and just think that if the dollar does start to strengthen, you know what happens is if it starts causing problems around the world, and this is what happens, is that if you've borrowed in dollars, and if in the last 6 or 8 or 10 months you've had a dollar that declines. So if you borrowed 103, which is where the dollar was at, and now you have to pay back and the dollar's down to 92. Well, goodness, look at the discount that you get. So you get to pay back. You don't pay back 102 or 103. You pay back 92. So what a boon for the rest of the world, and what a boon for anyone that's manufacturing and shipping around the world. All you have to do is the conversion rates are, give you an automatic 10, 11, 12% push, sometimes 14, 15%. So it kicks your profitability right in the back, and it gets you going, but doesn't necessarily mean that you've really done anything. It's just the fact that the currency has changed. So if the currency changes and we start talking about that the U.S. dollar gets stronger, you don't get those advantages. And what happens is that you start having things start to implode a little bit. And as things start to implode, more and more people want to get out of whatever currency they're in and get into the U.S. dollar. So it kind of makes for a cascading effect, and just makes it that much harder for anyone to do business. And of course, we have some very, very fragile economies around the world. If everything is just running perfectly, which at the moment we seem to be doing really, really well, it's fine, but they're fragile. And once we start getting some changes, and of course it's going to change, these things all run, nothing goes in a straight line. So things change. And so I think we're getting very, very close to that. So as a trigger point, I think I start looking at, but again, the reason I want to talk today is the fact that I've been saying how bad the stock market is. I do that because 70% of retirees, most of their money is in the stock market. So if you lose 30, 40, 50% in the stock market, you are not going to feel very, very wealthy at all. But the biggest market in the entire globe is the bond market. It dwarfs the stock market by trillions of dollars. The bond market is just enormous. Now, let's just think this through. If you have interest rates down at 0, typically they're 5 or 6%. Here in the United States, they're typically 5 or 6%. So when you have interest rates down to zero in Western Europe, they're negative, but they're really close to zero. So if you can get a 2-year bond, U.S. Treasury for less than 0.5%, that's pretty close to zero. So the U.S. Treasury, the 10-year Treasury, typically runs 5 to 6%. Today it's like 2.2. It's like a third of where it should be. Now, if you are a municipality and you have rates that are so low, I'm going to tell you the politicians are not economists. They couldn't keep a budget. I don't think they could balance a checkbook if they had to. And most of the time they don't have to. They just go borrow some more money. So they have gorged themselves on debt. Gorged themselves. You're paying 0.25%, 0.5%, and they never pay it back. It's not like we borrow $10,000 and now we owe you $10,012 because we've got such low interest rates. They go out and borrow $10,025 so that they can roll it over, but they never pay it off. They just add to the debt, so the debt keeps getting higher and higher. So now these politicians have added so much debt that they're struggling to balance their budgets when we're talking at near zero. So, I'm in my 60s. I actually remember when interest rates were more than zero. I mean, they've been zero for almost 10 years. So that alone should tell you something is radically wrong. Interest rates have been zero for almost 10 years. Something is wrong. So now you've got Yellen saying that they're going to start raising interest rates and they're not going to be accommodative. So what happens to the economies? What happens to the bonds when interest rates start going up? Now, Chicago has got a terrible credit rating. Illinois just lost some of its credit rating. Matter of fact, for that, China was just downgraded. And we're paying almost zero. So if you want to get a bond with Chicago, I think you have to pay 5 or 6 or 7%. Why is that? Why would you, when interest rates are almost zero for Chicago or the Chicago Board of Education, why would you be paying 5, 6, or 7% for interest rates for one of those bonds? The reason for that is you might not get paid back. The risk is rising. And as interest rates go up, it doesn't necessarily mean that there's demand on money. You don't have to have a booming economy to have interest rates go up. You have to have the fact that you might not get paid back to have interest rates go back. Why do you think Greece is paying almost 10%? Nobody's doing business in Greece. Greece isn't like the industrial capital of the world. Greece is just getting by. Greece is like, they've got the fun in the sun and everybody retires when they're 45 and, they sit down at the square and have coffee. But they're paying almost 10% money, 10% interest on the money that they're borrowing. Why is that? It's because they don't feel like you're going to get paid. So when you have credit risk rising, and this is sovereign and municipal and state problems, then risk is rising. When risks rise, if you're going to take a risk, are you inclined to give them a better deal on your interest rate? Probably not. Probably more inclined to raise the interest rate and say, hey, I'm running a risk that you might not pay me back, so I want a little bit of a risk premium in that. So interest rates go up. So that can become a trend. So if you have a trend where people start to think, and let me tell you that the world is awash in debt. Awash in debt. I mean, just look around you. Talk about your own municipality, your own village, your own city, your own town. Look how much money they owe. And they have to pay it back. So when payback starts to get a question, rates head up. Let me tell you what happens when rates go up. There's an inverse relationship. So as rates go down, bond prices go up. People have had a heyday for the last 8 or 9, 10 years because interest rates went from 4, 5, 6% down to zero. They've done very, very well on the capital gains. Bonds became more valuable. If we get a trend and a pendulum that's heading back, then I'm going to tell you the reverse is going to happen. And not only are you going to have interest rates start going up and see your risk premiums start going up. I mean, obviously, the more you have to pay back, the higher the risk premium becomes. But also, not only are you going to have a credit risk, you're also going to have a market risk because interest rates will rise along with that. So I don't know what the time frame is, but I'm going to tell you, I think it's baked in the cake. So just watch the U.S. dollar. I think the U.S. dollar is going to be the trigger point for both the stock and bond market. But remember, I say that most retirees have 70%. You know, a lot of them have 30% in bonds. And I'm going to tell you, most people can't stand a 20, 30, 40, 50% loss in bonds, 50, 60% loss in bonds. Sometimes, you know, a lot of these municipalities may go to zero because they won't pay back. You know, like Puerto Rico, people had all their Puerto Rico bonds. They didn't pay. So lots of problems coming in the world. So I just tell you that it's not the time to be bold and aggressive. It is the time to start thinking about plan B. So I would talk to your advisor, start thinking, well, you know, how balanced are we? Am I overweighted in stocks and bonds? And if I am overweighted in stocks, keep in mind that it's the FANG stocks, Facebook, Amazon, Netflix, and Google that are driving the market, because the rest of the S&P, a lot of S&P is down below the 50-day moving average, which is a technical a technical concern. So we need to watch that. So I would talk to an advisor, say, look at, what happens, am I overweighted? Maybe I should take some money off the table. You've done really, really well on stocks and bonds. My real estate business, where we do, we do a lot of pension work too. We're in the income business. We make income for people, and we just try and be as conservative and as safe as we possibly can. I'm not saying we're safe. We're safer probably than most everything else. We learned that in last 2008 that prices can fluctuate up and down. However, I think we have a huge, enormous payoff. If you read my work and do my work, you'll know that we have a horizon around 2023, 2024, where we think we're going to really do really well. So we're accumulating for that. In the meantime, we're taking income. So my very best to you, I would let me just recap this. I think there's again an awful lot of risk in the bonds. I think the federal bonds are probably pretty good, but here again, once you get a trend and you get a trend of rising interest rates, I don't know that the federal government is going to be immune from higher interest rates. So if you get higher interest rates around the world, because we have risk premiums and we have market premiums coming into effect, U.S. Treasury bonds could be affected just as well as anyone else, in which case you're going to lose money. So my very, very best to you. Please, we're here. We have a staff here. We're more than happy to consult with you. We're more than happy to talk with your significant other. We're more than happy to talk to your advisor, your accountant, your tax accountant, your attorney. We'll talk to anyone we can. We're fiduciaries here. We're going to do everything we possibly can for you. And just let us know if we can. We'll put our contact information on there. So. Listen, once again, this is Michael from Scottsdale, Arizona, wishing you the very, very best.